these are our products. I'm not going to go through them because if I look around the room, there's only 3 products that most of the people in this room are in. But, I mean, we do, like I teach a commodities class at CU, and we do have a commodity hedge that we use. It's done very well, the red line, compared to the other hedges. And this is the oil market. I need to extend this out. But I had a client come to me. He lives in Chicago, so he's convinced gold is going to go to the moon. And so he called me up and said, can you hedge my position? So we use gold as a commodity, so we use this hedge. Another hedge, we don't use this in our strategies that you guys are in. I put a white paper on this in your packet. There's a hedge fund in Chicago that's using this, a $5 billion hedge fund. The reason I don't use this hedge is it doesn't really work very well on the first leg down. It really only works when you get a real drawdown. So it did really well in 2020. It popped up very nicely in 2020. So let's just talk about the 3 strategies that most of the people in this room are in. I'm going to go a little deeper than I usually go. If you want to tell them that we're just about at the end. I want to talk about the absolute return. That's why I have my money. Most of the people in this room have the absolute return strategy. The absolute return strategy has to change as the surface changes. This is 2000 and 2020. When the market fell off a cliff, we did well, and I was very pleased. Now, as the market bounced, the surface changed. My engineers didn't recognize it quick enough. I'm not blaming you, okay? I just dropped your salary, okay, and I think I beat you. No, I'm kidding. But anyway, the surface changed, and as the surface changed, we should have changed quicker. So I wasn't happy. I was happy with the drawdown. I wasn't happy with the bounce. So in 2021, we had a very different surface, and you could see the market was up about 26. We were up about 18 and change net on the absolute return. The surface was pretty stable through that 2021 rally. 22 hit. The market came down. We don't try to hedge the first 5%. Then we start to hedge off. We were down, the market was down about 9. We were down about 7. And then the surface changed. As the surface changed, we repositioned and we put our portfolio in a very different position. So this is how our portfolio looks today, Jack. Does this help? It shouldn't help because you're thinking, what the hell is that? Okay, let me explain, Jack, what that is. Okay, first of all, this is a 60-day structure, Carlisle. So my absolute return strategy doesn't look very different than a structured note that you might buy. Here's what we're doing. Let's examine this side. First of all, as the market started to drop, you can see that the strategy has done a much better job since the end of February of hedging off that downside risk. We've really been able to cut off that downside tail. Here's how it works. Today, my beta is 68, 70. Market's been rallying. So that means my participation, market goes up 10, I go up 7. That's what we call my slope. But one thing that happens, as the market goes down, my slope automatically, my risk of my portfolio starts to drop. Because I have something called curvature in an option, or we call it gamma. But the bottom line is, at the low of the market, my participation, at the low of the market, at the end of the 1st of June 30, our beta was about 10 to 20. So when I get a call from somebody in this room and say, Dom, we're down about 10, 11%, I'm concerned. My attitude is we don't really have much downside in this market because our beta or slope is very low. And the reason that happens is because when you own an option, it has automatic curvature. In other words, as the market goes down, it automatically participates less and less. And as the market goes up, we participate more and more. It's actually the perfect market timing tool, and I don't have to time the market. I just got to say, okay, Pat, he says, market's down 2% today. Your participation rate went from 70 to 50. Market drops another 2%. He calls me and says, your participation rate just went from 50 to 30. Market bounces went from 30 to 50. So I'm not sitting here getting in and getting out and getting in. So options are a great tool to manage risk, and I always are invested. I'm always in the market. Now, I've lost people in this room, and I appreciate that. But as the market bounced over the last several weeks, my beta has risen, and that's where we are today. That's where we are today. So hopefully that helps. Let's look at the other side of the equation, which helps pay for these, because these are not costless. Is I am exposed this side of the equation. I have half exposure to the market, but I'm 9% out of the money on that exposure. So Jeff, what that means is if the market drops, as long as I hold these puts to expiration, I'm not going to lose any money on that position because there's no loss. In fact, if the market was down 20%, the first 9 I wouldn't lose $1, and then the next 11 I'd only lose half of that because my exposure is only half notional. We call that half notional. So this is why I can sleep at night. This is why I can sleep at night. Okay, because if I get a call and the call, my client says to me, well, what if the market goes down 20%? I can almost tell you mathematically, I'm okay with this. Yes, are we losing money? Yeah, but the secret to investing is you don't need to win, right? You just need to lose less. And you and I have spent a lot of time talking about that. So, and then let's talk about the other strategy I have some clients in is the income strategy. I use T-bills and I sprinkle in some short puts way out of the money, very little, and it's been doing well. It's up about 4.5% APR year to date. And so those are about, in this room, those are the three. No. Carlisle, I can't forget your favorite investment. Carlisle's been with me forever. And Carlisle, I don't know how long you've been doing structures with me, forever? A long time.